Well, good morning, almost good afternoon. I'm Kriti Gupta, and with me is John Authers in person.
Yes.
Lots going on here. I am filling in for Lisa Abramowitz. She picked a great day for me, horrible day for her because there's so much going on in the market. She will, of course, be back next week for our risks and rewards segment, but let's just get into the news here, which is inflation. And right now, very apt conversation because Chairman Powell is speaking right now in a Bloomberg panel to our very own Francine Lacqua. Two very key headlines coming out already from that, John. The U.S. Central Bank would raise rates if the Fed sees serious risks of higher inflation. Powell also saying this is not a situation that our patient approach of framework was designed for. Those are some not market-friendly things to say.
That's very much so. I think the latter comment in particular is central banks can never really admit to an error, can never admit to not knowing what's going on too directly. But that's about as close as a central banker can ever to say to, okay, plan A isn't working. We're going to have to change plan here, folks. And that is an extremely big deal, which neither of us have had more than about 2 minutes to think about. Very quickly, in terms
live
of
TV, folks.
Yes,
live TV.
Yes, who would dare have anything else? The one point I would make, which I hope we might even have a chart for this, is that just before he spoke, 5-year inflation break-evens had broken to the highest they had ever been. Point one only goes back to 2002 inflation-linked market. Doesn't go back that far. Point two, yes, they do tend to move with oil prices, but oil prices were actually down today. Oil prices were far higher than this in the great spike of 2008, and inflation forecasts are higher now than they were then. So yes, there are some caveats on this, but the fact that 5-year inflation forecasts are at a record does mean something pretty important. The other thing that's quite interesting in terms of the immediate reactions to Powell is that the yield curve, this is really sexy stuff we're talking about here, the yield curve has tightened very dramatically. Again, we're talking about the immediate market reaction, but that isn't surprising. It implies more of a risk that rates will be going higher in the short term, meaning that in the longer term, they will kill off the growth and mean lower rates further out. It's not necessarily a healthy immediate reaction.
Well, it's interesting how this is translating to the belly of the curve, really, because for forever, people were looking at 2 years. And essentially, the idea is that just the front of the curve is so Fed focused at the moment. You can't really read what's really happening in terms of what the future expectations are. 10 years are way too far out. So the 5-year has become this kind of beacon of are they not going to be raising or raising rates in, let's say, the next year? And the market is very, very divided on it. I think you brought up a great point about commodities in particular. Oil has so much to do with it because we're hitting what $85, I think, a barrel is what we hit. It's the highest since 2018. If you go back to the peak of 2018, that was $86 a barrel, and it crashed as the trade war kind of unraveled. Go back even further, and you're starting to talk about $90, $100. So this is really a unique environment, and when we're talking about energy-driven inflation in particular, and I think the best example, I'm gonna go cross acid here, John. Bear with me.
Good for you.
You taught me well. I'm gonna go across the acid here because we are hearing from airlines, which is, I think, for me, the best gauge right now of consumer spending ability, and of course how they're ramping up with kind of this post-COVID era that we're living in. And you're starting to see airlines just say jet fuel costs are surging. And if you actually look at the crack spread between jet fuel cost and Brent, we already know oil is skyrocketing. Jet fuel is going even faster. So how essentially do you translate this into actually making your bottom line? I think it's the perfect case study for what you're seeing in the broader economy of whether these companies can absorb the costs or whether they can't.
Yes, and indeed, amplifying that, I completely agree with what you just said. If you take a look at the bottlenecks situation, we've moved beyond, I think Powell has now absolutely clearly stated that we've moved beyond the transitory debate. It's not, I think transitory meant this is purely a blip caused by low base effects. It will go away without our needing to do anything. That plainly isn't true. It wasn't a stupid thing to hope for a few months ago, but we now know that it's more than that. If you look at used car inflation, which was obviously Exhibit A for those who believed that it was transitory, the used car inflation earlier this year was just insane. There was no way you could sustain doubling of prices. Used car inflation was something like 9% in the first 2 weeks of this month. according to the Mannheim indicator. So there is, and this again, the crack spread. The problem with airline fuel is another example of this. It's not just that the ultimate commodities are going up. It's when you try to get them through these overstuffed pipes in the global economy, it gets more expensive still.
And that's why I think, I mean, let's go cross regional. We went across that, so let's go cross regional. The energy crisis in Europe is fascinating right now, and it gets very geopolitical there. So we'll put the geopolitics aside for a second. But the whole concept of, with regret, there's only about 10 minutes left. But I mean, the whole nat gas just surging, and really this dependence of Europe on essentially Russian supply is turning into a geopolitical story. And a big chunk of that is what's going to happen globally. Now, I want to pivot here from inflation to China, because it is actually all connected in some way. John, there's a phrase from years ago, and I have to say this delicately because, of course, we are in a pandemic, but there was a phrase from years ago, especially in 08, 09, that if the U.S. sneezes, the rest of the world catches a cold, essentially implying that if the U.S., if something goes wrong, whether it's zombie companies, whether it's a financial crisis, the rest of the world follows their lead to the upside and to the downside. And my big kind of theory at the moment is that China is becoming that new player, in that whatever happens, whether it's an Evergrande story or massive spending, their middle class getting richer and richer and able to spend, able to take part in their market. How does that trickle into the rest of the world? And there's a debate to be made here that on the one hand, it's the most growing economy at the moment, major economy at the moment. But the flip side of that is we are in a pandemic. We do have these supply chain issues. At what point is that kind of deglobalization from the trade war amplified in this post-COVID era?
Well, I think it's probably been amplified in markets in the last few months. I mean, there's more than just deglobalization going on. There is also the shift away from capitalism, or the shift against the private sector from Xi Jinping. But if you take a look at the performance of Chinese ADRs, I hope we have a chart for this as well. You know, these the big Chinese companies that are actually listed in New York. The kind of fall from grace they've suffered in the last few months is nothing short of spectacular. Now, if you look, we got our latest download of information from China economic data the last week. Their consumer price inflation is more or less totally under control, barely 1% off the top of my head. Their PPI, producer price inflation in round numbers, is just over 10%. The great fear, which I have been worried about for a while, and which I think, because confirmation bias maybe, but also because the data seem to suggest it, is beginning to happen, is that after 2 decades of exporting deflation to the rest of the world with positive and negative effects, China is now exporting inflation. That these problems that China is having, it has a fuel crisis of its own. If you take a look at what's been happening with metals prices, which are all over. Incidentally, the inflation scare in bond markets has come just as metals prices dropped very sharply the last few days. I have no explanation for that whatsoever. But plainly, the Chinese situation at this point, the growth is slowing. People are very concerned about whether they can trust China in a way that there were reasons to question this for decades, obviously, but it's the behavior of the regime in the last few months have suddenly created this new perceived risk premium, this new element of risk surrounding China, and that definitely does add to the risks in the whole global situation. It does add to the inflationary pressure in the West.
Well, John, I was just looking up the chart for the ADRs, like you said, and you did it relative to the S&P 500. But if you actually just look at the index itself, the NASDAQ Golden Dragon Index, which houses a lot of these ADRs, very tech focused, from their peak in February when they were all the rage, 53% decline. I mean, it's huge. I mean, imagine losing half your value in half a year, essentially.
Yeah, you don't need to be a journalist to call that a crash.
Right, exactly.
And bona fide
you nailed it. It has
crash.
Everything to do with the regulatory environment. My big question, though, is at what point do you hop in? At what point are those risks worth it? And you're starting to see them kind of create a little bit of a floor the past couple months, trading in a range, and potentially actually on days that are up days, on days that are led by tech, Chinese ADRs get in on that trade as well, and they do benefit from that investor bid.
I'd agree with that. You certainly do see quite a few. I've seen very few papers from large houses saying, yes, buy Chinese equities now. There is an interesting opportunity for active boutiques to take a risk in China at the moment. In a way, if you want an underestimated risk, which when Lisa and I started doing this, we were going to try to do under and overestimated risks each week. If you want an overestimated risk, one where there is a chance to make some money, it would be China. That said, there is this big imponderable governance political issue there, and a lot of the bigger institutions are under political pressure here in this country. People like Marco Rubio, very vocally saying you shouldn't be touching China anyway. It's for the time being, it's a rare case when the smaller, nimbler, genuinely active shops are going to have a chance.
And
ESG funds are not going to be buying China.
This is such an important issue because then it feeds back into the whole supply chain thing we're talking about. I mean, there was a report this morning that Intel, which of course is trying to revamp their major company, they're talking about building a new chip plant, not in the United States, but in Italy of all places. I mean, it's fascinating to see this supply chain really churn. And it's not necessarily because of the pandemic, as we thought about. Some of this is in fact geopolitics. And you're starting to see these new kind of paths of making things come from all over the world. I mean, Intel was also talking about building plants in places like Arizona, like Austin, like Virginia, for example. And now, well, I mean, lots of places, right? It's they're not alone, but they are trying to revamp their company. Nvidia is another example with their acquisition in the UK. I mean, you do have these major kind of reality checks that you're starting to see in the US global supply chain. I mean, we were covering, or we're preparing, I should say, on the Bloomberg TV side for Apple earnings next week. And 60% of their cost of goods sold go to one company. It's Foxconn. And it's huge because they,
that I didn't know. That's quite
fun
remarkable.
Fact for you and our viewers. I mean, because I'm just going to throw this out there because I learned also this very recently. But basically, Foxconn, they buy the materials, they assemble it, and then they sell it to Apple. So 60% of their cost of goods sold to that one company, which is pretty fascinating. But it's just exemplifies.
Can I hit you with one brief factoid before we go further? Intel does have a very good history of being very smart at spotting good countries to locate. The great success story, economic success story of Central America in the last few decades has been Costa Rica. And
more than just its beaches.
And the main reason for that was that Intel chose to base a very big plant there.
Interesting.
Back, I think, in the late 80s, early 90s.
But then it brings to the point here, the emerging markets versus developing markets or developed markets, right? And at what point does COVID factor into that situation? We could go on with that conversation forever, but we only have a couple minutes left, and we have to hit one of the big stories this week, which is Bitcoin.
It's remarkable that it wasn't the biggest story of the week because it's at an all-time high. We've had the second most successful ETF launch of all time this week.
And another one this morning, I should say, the Valkyrie ETF is making its trading debut, but down, I believe, 2% at the open.
It's called Valkyrie.
Valkyrie is the company. It is called the Bitcoin Strategy ETF, I believe.
Valkyrie is a Wagnerian opera, providing they don't get to the final part of the cycle, which is Twilight of the Gods, which when they get to the Twilight of the Gods ETF, that we know that Bitcoin's finally going to blow up. Anyway, if you take a look at Bitcoin over time, I hope this is another chart we had ready ahead of time. What's remarkable about this rise for Bitcoin compared to the previous ones is that it's had what looked to all the world like a classic bubble, and the idea of a bubble is that it bursts, there's nothing left. That burst at least 3 times in the past, and when it bursts, it doesn't actually collapse altogether. It just loses a lot of value and then comes back about 2 or 3 years later. This time, it's tanked earlier this year, and it's back inside of 6 months, and it's doing so with much less excitement in the world at large. It's now becoming more of a financial asset, less of a consumer asset. It's extraordinary.
Well, the institutional bid that you're starting to see really show up is huge. And I think you had a great chart. And I think I'm going to take the last word here, John.
Good for you.
You had a great chart here in one of your columns this week about Bitcoin and bonds, specifically 5-year yields. And they do actually track each other quite well. And you're starting to see that cross-asset dynamic on these inflation bets, on these riskier risk sentiment resurgence showing up in Bitcoin. I think that's just evidence here that there is a cross-asset trade in play, and it is the institutional buyer that's starting to get their mind wrapped around this.
Right.
So on that note, there's plenty more to talk about, but to our viewers, thank you so much for joining us. Lisa will be back next week with John. I will be back probably around the holidays because, Lisa deserves a break.